Adjusting entries are not as hard as you may think. They are entries made into the journal to record revenues that have been earned but not recorded, and expenses that have been incurred but not recorded. An easy rule to remember is that cash is unaffected by adjusting journal entries. Every journal entry will affect at least one revenue or expense account, as well as one asset or liability account. There are 4 different scenarios where adjusting entries are used. When cash is received before revenue, deferred revenue is earned. When cash is received after revenue, accrued revenue is earned. When cash is paid before expense, deferred expense is incurred. And when cash is paid after expense, accrued expense is incurred. Adjusting entries are important because they follow the accrual basis of accounting, where accountants record revenues when they are earned and record expenses when they are incurred. This follows the generally accepted accounting principles and is important for all businesses to follow. An example of when an adjusting entry is needed is when a company has accrued expenses before they would normally be recorded. Suppose a company is at the end of a month when they incur an expense for employees who worked in that month. Because of the generally accepted accounting principles and accrual basis of accounting, the expense needs to be recorded when it is incurred and not when they are paid. Because of this, an adjusting entry needs to be made at the end of the month to record the salaries expense. Salaries expenses are debited and the salaries payable are credited. Note that cash is unaffected by this journal entry.